Welcome, everyone. We're doing a deep dive into your sources today, looking at some really crucial shifts happening in real estate and finance.
That's right. Our goal is to cut through the noise and pull out the key insights on money, taxes, investing. Basically what you need to know.
Okay, let's jump right in. The data on delinquencies, it seems. Well, it tells kind of a split story, doesn't it?
It really does. It's fascinating. You hear general headlines, but when you dig into the sources, the difference between single family and multifamily is pretty stark.
Yeah, that's what I saw. Single-family serious delinquencies. They're actually holding steady, maybe even down a tiny bit.
Uh-huh.
Freddie Mac at 0.57%, Fannie Mae 0.55% in April, according to the sources. Seems fairly resilient there.
Exactly. But then you look at multifamily, we're talking 1 to 4 unit properties here.
Right.
And wow, it's a different picture. Serious delinquencies have climbed pretty significantly to 0.63%.
Okay, 0.63%. Now, that number itself might not sound huge.
Maybe not in isolation, but the key thing the sources highlight is the trend. It's the highest it's been since 2011 if you take out the weird pandemic spikes.
Since 2011.
Yeah.
Okay, that puts it in perspective. So why? Why the big difference?
Well, the main driver seems to be this massive wall of debt maturing. We're talking almost $1 trillion in multifamily debt coming due this year.
$1 trillion. Wow.
Yeah, and think about it. Current interest rates are way higher than when those loans started.
Right. So refinancing is tricky.
Tricky is putting it mildly. It's extremely difficult for a lot of owners. So this isn't just a challenge, it's creating real pressure. Could create opportunities too, but definitely something you need to watch closely.
Makes sense. Okay, let's shift gears a bit. Taxes, always important. The sources mentioned some potential changes coming.
Yes, definitely. And it's a mix. There's some potentially good news, like bonus depreciation might make a big comeback.
Oh, that'd be huge for new investments, accelerating deduction.
Absolutely. A powerful tool if it happens. But there's also potential bad news on the horizon.
Okay, like what?
Like the possibility of estate exemptions shrinking, that's crucial for, long-term wealth transfer.
Mm-hmm.
And maybe more immediately relevant for many listeners, the potential loss of some key pass-through tax perks.
For LLCs, S-Corp, that kind of
Exactly. If those go away, it could mean a higher tax bill for you, even if your income hasn't changed.
So, bottom line, these aren't just small tweaks. They could fundamentally change how you structure deals, how you manage wealth.
Precisely. Which actually leads nicely into another point from the sources, property age and costs, but with a twist.
Yeah, this one surprised me. The idea that brand new homes, in some markets, might actually cost the same or even less than older resale homes.
Once you factor in insurance, yes. It sounds counterintuitive, right?
Certainly. How does that work?
It boils down to insurance premiums. They're just skyrocketing on older homes. Aging pipes, roofs, wiring, higher risk.
Plus rising repair costs in general.
Exactly. Compare that to new construction built to modern codes, resilient materials. Sometimes you even get insurance incentives.
So the sticker price isn't the whole story. You have to look at the all-in cost.
Uh-huh.
And insurance is becoming a huge piece of that puzzle, especially with older stock.
Definitely. Understanding that insurance angle based on property age is key for your cash flow projections now.
Okay. And related to owning property, business structure, the LLC question comes up a lot.
It always does. The sources mention Ashley Kerr from Bigger Pockets, and her take aligns with the overall message. There's no single right answer. It really depends on your goals.
What are the main trade-offs the sources highlight?
Well, the big pro for an LLC is liability protection, separating your personal assets from your business debts. That's really important.
Crucial, yeah. But there are downsides.
Sometimes. Financing can be one. Lenders, especially for smaller portfolios, often just prefer lending to an individual. An LLC can add a layer of complexity there.
Okay. And what about the tax side? Does an LLC automatically save you money?
That's a common myth. An LLC gives you flexibility in how you're taxed, like an S-Corp election, potentially. But the LLC structure itself doesn't just magically lower your taxes.
So deciding on an LLC means weighing that liability shield against maybe some financing hurdles and really understanding the actual tax implications for your situation.
You got it. Consulting with legal and tax pros is pretty essential there.
Good advice. Just wrapping up with a few quick takeaways from the sources. They reinforce the basics too, right?
No, absolutely. Things like pricing your property correctly, using comps, understanding demand, still fundamental.
And keeping occupancy up. Tenant satisfaction, quick repairs, good marketing. That stuff still matters for cash flow.
For sure. And despite all these shifts we're talking about, the core message remains. Real estate can be a powerful long-term investment. Leverage, appreciation, cash flow, tax benefits. This holds true.
Yeah.
And one specific resource mentioned was NREG, National Real Estate Investors Group. Yeah, specializing in insurance just for real estate investors. The point being, they actually understand investment properties, which can be helpful if you're tired of explaining your business model to standard insurers. Might be worth checking out.
Good tip. Okay, so we've hit on market dynamics, potential tax shifts, the surprising insurance impact of property age, and LLC considerations.
Quite a bit to digest. It really leads to a final thought for you, the listener, to ponder.
Given everything we've discussed, the maturing debt, those rising insurance costs on older places, potential tax changes like bonus depreciation or pass-through rules, what part of your current strategy, whether it's real estate or broader investments, might need the most critical look right now? Something to think about.